If you're watching this video right now, you need to stop everything you're doing because what I'm about to show you is absolutely mind-blowing. Silver just crossed $80 per ounce, and the financial institutions that have been suppressing this market for decades are now warning of wild price swings that could change everything for precious metals investors. This isn't just another market update. This is the moment that silver investors have been waiting for, and if you don't understand what's happening right now, you could miss the most significant wealth transfer opportunity of this decade. Let me paint you a picture of what just happened in the last 72 hours. On January 9th, 2026, silver opened at $78.74 per ounce. That's a $4.31 jump from just 24 hours earlier. But here's what nobody in the mainstream media is telling you. This isn't just a random price spike. This is the beginning of a structural shift in the silver market that Goldman Sachs themselves are now warning about. And when the same institutions that have been on the short side of this market for years start issuing warnings about wild price moves, you better pay attention. Think about this for a second. Just 1 year ago, on January 1st, 2025, silver was trading at $28.92 per ounce. Today, we're looking at prices hovering around $80. That's not a typo. That's a 154% gain in just 12 months. Show me another asset class that has delivered those kinds of returns while maintaining its status as a safe haven investment. You can't, because it doesn't exist. But here's the part that should really get your attention. The institutions know something that retail investors are just starting to figure out, and they're positioning themselves accordingly. Oh, I know what you're thinking. You've heard these stories before. Every time silver rallies, someone comes out and says, this is it, this is the big one. But this time is genuinely different, and I'm going to prove it to you with hard data that the mainstream financial media is completely ignoring. The convergence of factors we're seeing right now has never happened before in the history of the silver market. We're talking about supply constraints, geopolitical chaos, institutional repositioning, and a physical shortage that's getting worse by the day. Let's start with the Venezuela situation, because this is where things get really interesting. On January 5th, 2026, the United States led an operation that resulted in the arrest and extradition of Nicolas Maduro. Now, you might be asking yourself, what does Venezuela have to do with silver prices? Everything. Venezuela sits on some of the largest oil reserves in the world, and the geopolitical implications of this event are sending shockwaves through commodity markets. When political instability hits a major oil-producing nation, investors don't run to stocks or bonds. They run to precious metals. Gold saw a 2.8% surge to $4,451.50 per ounce on this news. But silver? Silver absolutely exploded with a 7.9% jump to $76.65 per ounce. That differential is critical because it tells us that silver is moving faster and harder than gold in response to geopolitical uncertainty. This is what we call beta in the market. Silver has always been gold's more volatile cousin, but what we're seeing now is unprecedented momentum that's catching even seasoned traders off guard. But the Venezuela crisis isn't happening in isolation. President Trump has made it clear that American dominance in the Western Hemisphere is a priority, with direct threats being made against Mexico, Cuba, and Colombia. This isn't just political posturing. These are real geopolitical tensions that create real demand for safe haven assets. And when you combine this with the fact that industrial buyers are scrambling to secure silver supplies for solar panel production and electronics manufacturing, you're looking at a perfect storm of demand factors that are all hitting at the same time. Here's where it gets even more interesting. The premium you're paying for physical silver over the spot price has jumped to $7 to $10 per ounce for silver bars. That means if spot silver is trading at $75, you're actually paying $82 to $85 for a 1 ounce bar. For American Silver Eagles, those premiums are running between $10 and $17 over spot. Some dealers are quoting $85 to $92 per coin. Why? Because the physical market is tight. And when the physical market is tight, premiums explode. Now let me show you something that's going to blow your mind. Goldman Sachs, one of the most powerful financial institutions in the world, just issued a warning about wild silver price moves in the coming months. Let that sink in for a moment. Goldman Sachs, the same institution that has historically been on the short side of precious metals, is now telling the market to expect extreme volatility. When your enemy starts agreeing with you, that's when you know something big is about to happen. But what exactly is driving this warning from Goldman? It all comes down to something called the Bloomberg Commodity Index Rebalancing. And this is where things get technical but absolutely critical to understand. Every year, Bloomberg and S&P Global rebalance their commodity indices based on the previous year's performance. Passive funds that track these indices have to sell the outperforming assets and buy the underperforming ones to match the new weightings. And silver, my friends, massively outperformed last year. Here are the numbers that matter. Bloomberg is cutting silver's weighting from 8.19% in 2025 down to 3.94% in 2026. That's more than a 50% reduction. The Goldman Sachs Commodities Index is doing the same thing, slashing silver from 1.23% down to 0.65%. Now, you might think this is bearish news, and in the short term you'd be right. But here's what the institutions aren't telling you. This rebalancing represents approximately $6 to $7 billion worth of silver futures that have to be sold over a 5-day period starting January 8th. Think about the mechanics of what's happening here. These aren't discretionary sellers making thoughtful decisions about market timing. These are passive funds that have no choice but to sell because the index requires it. This is mechanical selling, and it's creating a temporary dislocation in the paper silver market. But here's the critical insight that separates the smart money from the dumb money. This selling pressure is happening in the futures market, not the physical market. The futures market and the physical market are two completely different animals, and right now they're telling two completely different stories. While passive funds are dumping futures contracts to meet index requirements, the physical market is getting tighter by the day. COMEX eligible silver inventory peaked at 342 million ounces on October 3rd, 2025. As of the latest data, we're down to 318.85 million ounces. That's a 6.85% decline from the peak. And on January 6th alone, 1,624 units were delivered from COMEX warehouses, the highest single-day delivery since December 30th. This tells us that people are taking physical delivery, pulling real metal out of the system. Now, let's talk about the ETF market, because this is where things get really interesting. Total known global silver ETF holdings stood at 849.99 million ounces as of January 7th. That's down 2.4% from the cycle high of 871 million ounces reached on December 23rd. Some analysts are calling this a bearish development, and technically they're right. ETF outflows typically indicate that investors are taking profits, but here's what they're missing. Those ETF holdings are still at their highest level since June 2022. We've seen about 1.5% year-to-date outflows, but we're still sitting near multi-year highs. What does this tell us? It tells us that despite some profit taking, the overall accumulation trend remains intact. Smart investors understand that temporary pullbacks in a bull market are buying opportunities, not selling signals. And when you've got physical premiums running $7 to $17 over spot, that's telling you that the real demand is in the physical market, not the paper market. The ETF holders who are selling right now are probably rotating into physical metal to avoid counterparty risk, which is actually a bullish sign for the overall market. Let us talk about lease rates, because this is one of the most underreported indicators in the precious metals market. The 1-month silver lease rate has eased to 4.46% from the 7% plus levels we saw until recently. Now, 4.46% might not sound high until you compare it to the historical average of 0.3 to 0.5%. We're talking about lease rates that are roughly 10 times higher than normal. What does that mean? It means that there's a cost to borrowing silver, and that cost reflects the tightness in the physical market. When lease rates are this elevated, it's because there's real demand for physical metal from industrial users, and they're willing to pay a premium to secure supply. The solar industry alone accounts for 16% of global silver demand and has been growing at 14% per year for the past decade. The electric vehicle industry is adding another 2.9% to global demand. These aren't speculative buyers. These are manufacturers who need silver to make products, and they can't just decide to stop buying because the price went up. Here's something that's going to shock you. This is information that very few people in the precious metals community are talking about. China has implemented export restrictions on silver, and this is creating a fundamental shift in the global supply chain that could push prices even higher. Think about what this means. China is one of the world's largest silver producers, and they're essentially telling the rest of the world that they're prioritizing domestic supply over exports. When the world's factory decides to hoard a critical industrial metal, that's a massive red flag for global supply availability. But it gets even more interesting when you look at what is happening with Chinese silver prices versus international prices. There's been a persistent premium in the Shanghai silver market compared to COMEX pricing, and this premium exists for a reason. Chinese investors and industrial users are willing to pay more for physical silver than the international paper price suggests it is worth. This is what we call backwardation in the physical market, and it's one of the strongest signals you can get that the physical market is disconnected from the paper market. Now let's connect all these dots and see what picture emerges. You've got geopolitical instability in Venezuela creating safe haven demand. You've got Trump threatening military action in Greenland and issuing warnings to Mexico, Cuba, and Colombia, which is amplifying geopolitical risk across multiple fronts. You've got China restricting silver exports and maintaining premium pricing in their domestic market. You've got industrial demand from solar and electric vehicles growing at double-digit rates. You've got COMEX inventories declining while deliveries are accelerating. You've got lease rates running 10 times above historical norms. And you've got Goldman Sachs warning of wild price moves. Each one of these factors individually would be significant. But when you stack them all together, happening simultaneously, you're looking at a setup that we've literally never seen before in the silver market. This is why sophisticated investors are looking past the short-term selling pressure from index rebalancing and focusing on the bigger structural picture. The index rebalancing will be done in 5 days. The supply deficit, the geopolitical tensions, the industrial demand growth, and the physical market tightness, those aren't going away. Let me give you some context on just how extraordinary this move in silver has been. Since 1921, silver has historically underperformed the S&P 500 by approximately 96%. That means if you would split your investment equally between silver and stocks, back then, the silver portion would be worth about 96% less today than the stock portion. This is why traditional financial advisors tell people to avoid silver. They look at the 100-year performance and conclude it's a terrible investment. But here's what they're missing. We're not living in normal times, and the next 10 years aren't going to look anything like the last 100 years. The factors driving silver demand today didn't exist for most of that 100-year period. Solar panels weren't a thing. Electric vehicles weren't a thing. The level of government debt and central bank money printing we're seeing today wasn't a thing. The geopolitical fragmentation and deglobalization we're witnessing wasn't a thing. You can't use backward-looking data from a completely different economic and technological environment to make forward-looking investment decisions. That's like trying to navigate a car by only looking in the rearview mirror. Here's what the smart money understands. Silver's historical underperformance relative to stocks is precisely what creates the opportunity going forward. Markets mean revert over long periods, and when you've got an asset that's been underperforming for a century, compressed by institutional shorting, and is now facing unprecedented physical demand from technological applications that didn't exist before, you're looking at a coiled spring waiting to release decades of pent-up energy. The gold to silver ratio is another critical metric that tells us where we are in the cycle. Currently, the ratio stands at approximately 57, meaning it takes 57 ounces of silver to equal the value of 1 ounce of gold. Historically, this ratio has ranged anywhere from 15 to 1 up to 100 to 1, with the long-term average somewhere around 60 to 70. We're slightly below the average right now, which suggests that silver still has room to run relative to gold. And if we see real stress in the financial system, that ratio could compress significantly lower, meaning silver would outperform gold dramatically. Now I want to talk about something that most silver analysts completely miss, and this is the difference between being right and making money. You can have the best analysis in the world, you can understand every fundamental factor driving the silver market, you can still lose money if you don't understand market structure and timing. The index rebalancing that's happening right now is a perfect example. From a fundamental perspective, nothing has changed about silver's long-term bull case. The supply deficit still exists. Industrial demand is still growing. Geopolitical tensions are still escalating. But in the short term, you've got $6 to $7 billion of mechanical selling hitting the futures market. This is creating volatility. And volatility creates opportunity for those who understand what's happening. Traders who don't understand the distinction between temporary technical pressure and fundamental deterioration are going to panic sell at exactly the wrong time. Meanwhile, institutional buyers, who understand that this rebalancing is a temporary phenomenon, are going to use this weakness to accumulate positions at better prices. This is how wealth transfers happen. The uninformed sell to the informed during periods of temporary technical pressure, and then they watch in frustration as prices recover and move higher. Let me give you some specific numbers to watch. If silver can hold support at the $70 level during this rebalancing period, that would be an incredibly bullish sign. It would mean that physical demand and long-term institutional buying is strong enough to absorb the mechanical selling from passive funds. If we break below 70, we could see a flush down to the $65 to $67 range, which would represent a healthy correction in the context of a bull market, and would likely attract significant buying interest. On the upside, if silver can break through and hold above $82, that would be a major technical breakout that could accelerate momentum and bring in trend-following algorithms and momentum traders. The $80 to $85 range is critical resistance. And once we clear that level convincingly, the next target zone would be $90 to $95. These aren't random numbers. They're based on Fibonacci extensions, prior resistance levels, and round number psychology that tends to attract both buyers and sellers. But here's what you really need to understand. The short-term price action over the next few weeks is going to be choppy and volatile. Goldman Sachs didn't issue their warning about wild price moves for no reason. We're going to see days where silver is up 5% and days where it is down 4%. This kind of volatility shakes out weak hands and rewards patient investors who understand the bigger picture. If you're someone who checks prices every hour and gets nervous when you see red, you're probably going to have a difficult time navigating this market. The key is to distinguish between noise and signal. The index rebalancing is noise. It's temporary mechanical selling that has nothing to do with the fundamental value of silver. The supply deficit, that's signal. The industrial demand growth, that's signal. The geopolitical tensions, that's signal. The Chinese export restrictions, that's signal. And the rising physical premiums, that's signal. If you can train yourself to focus on signal and ignore noise, you'll make much better investment decisions. Now let's talk about the elephant in the room that nobody in the precious metals community wants to address honestly. Silver is not going to make you rich overnight. I know there are channels out there predicting $500 silver or even $1,000 silver in the next year or two. Those predictions make for great clickbait, but they're not grounded in reality. What silver can do is preserve your wealth, provide portfolio diversification, and potentially deliver significant real returns over a multi-year period if the fundamental thesis plays out. If you bought silver at $30 and it goes to $100 over the next 2 to 3 years, that's more than a triple. That's an outstanding return by any measure. But you have to have realistic expectations and understand that getting from 30 to 100 isn't going to be a straight line. There will be corrections, there will be periods of consolidation, there will be moments where you question whether you made the right decision. This is normal and healthy for any bull market. The investors who will ultimately profit from the silver bull market are the ones who have done their homework, understand the fundamentals, have a plan, and have the emotional discipline to stick with that plan even when things get uncomfortable. The investors who will lose money are the ones who buy high because of FOMO, panic sell during corrections, and then buy back in at even higher prices. Rinse and repeat until their capital is destroyed by emotional decision-making and poor timing. So here's my final thought for you. We are witnessing a historic moment in the silver market. Prices have more than doubled in 12 months. Major financial institutions are warning of continued volatility. Geopolitical tensions are escalating on multiple fronts. Industrial demand is growing faster than supply. The physical market is tight and getting tighter. China is restricting exports. And despite all of this, the mainstream financial media is barely covering the story. When you see this kind of disconnect between what's actually happening in a market and what the media is reporting, that's usually a sign that you're early to a major trend. The big money always moves before the headlines. By the time silver is on the front page of the Wall Street Journal and CNBC is doing special segments about it, the easy gains will already be made. Right now, today, you still have the opportunity to position yourself before the crowd figures it out. Whether you choose to take that opportunity or not is entirely up to you. But at least now you understand what's really happening and why it matters. The silver market is sending clear signals to those who are paying attention. The question is, are you listening?